Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. My name is Alex Matthew. Now, this show gets you actionable insight on everything mutual fund related, and we're talking about a very interesting topic today. If you've looked at the performance of the equity markets, it's obvious that we are in the midst of a bull run, and it's been broad-based. The texture of the market has shifted on account of the rally that we've seen over the last 2.5, 3 years or thereabouts. In fact, at this juncture, you have the Nifty 50 and the weight of the Nifty 50 as a percentage of the whole market at its lowest that it has ever been. And the broader markets, because of the broad-based rally that we've seen, you have the small cap 250 index and you have the mid cap 150 index that have the highest weight in the overall market than they have ever had. And we're going to talk about how we reached this point and what this means for your portfolio, whether or not this is another trigger for you to consider rebalancing. We've got Pratibha Girish, who's founder of FinWise Personal Finance Solutions, as well as Varun Fatehpuria, who's a founder and chief executive officer of Daulat Wealth Management. Thank you so much to the both of you for taking the time. Pratibha, I'll come to you first. It seems a little stark when you look at it as things stand right now, but it has been developing for some time. Is this something that you talk about with your clients?
Absolutely, Alex. Thanks for having me on the show. As is always the case, when there is an uptrend in the market, mid cap and small cap tend to perform significantly better than large cap. So it's a kind of a vicious cycle, and money flows where where there is performance, money flows there, thereby pushing up the returns even further. The other thing which you need to look at is, after COVID, we've not seen a significant correction in the markets, except for the time correction which happened in 22-23, FY 22-23. Even the COVID correction, recovered really quickly. So the earnings have also supported this upward trend, broad-based earnings. So given the recency bias, many investors feel that they can be aggressive in the market cap allocation and maximize the returns in the short term. This has resulted in a share of mid and small cap being the highest ever. The market cap Nifty 50, which you were saying, is currently at 63% as compared to about 68-70% a few months back. The monthly average inflows also into, large cap and mid cap, it's starkly different. If you see in FY 23, it was about 698 monthly average inflow in large cap, vis-a-vis 3,000, 4,000 is a total, so, and it was minus 51 last year, but it's picked up recently, and this year it's about 1,060 crores in the large cap space. So even if you take into account large cap component of the money into various sectors like, flexi cap categories, if you look at that, still it's 60% mid and small and 40% large cap, which is not seen in many, many years actually.
Absolutely, that's a fair point. And there's a reason why that has happened. Varun's been looking at it as well. Varun, I asked, and I sent this data across and asked what you think about it. And you pointed out that there's a reason behind this. There is earnings growth also that has pushed this to happen.
Right. Hi, Alex. Firstly, thank you so much for having me back on the Mutual Fund Show. It's great to be talking to you. So as you correctly pointed out, obviously, if you look at the earnings for both large cap, mid cap, and small cap over the last few years, there has definitely been some sort of a support that has been provided by the earnings itself. So let's quickly look at the numbers. Large cap earnings have grown close to about 22 to 23% over the last 3 to 4 years, compared to about 36% for mid cap and 48% for small cap segment. So returns have been combination of both strong earnings growth and definitely some sort of a re-rating of the stocks that was a long overdue in the mid and the small cap segment over the last 3 to 4 years. So it has been a combination of both earnings growth and a PE expansion. And obviously, needless to say, as Pratibha pointed out, the kind of flows that we are seeing into the small and the mid cap segment over the last few years have only provided support to a lot of these stocks, especially one with a very high promoter shareholding or a low float stock, where there is a concentrated holding. So obviously there is no true price discovery, so to speak. So I think, yes, definitely, I think earnings have provided that sort of a support to the kind of returns that we are seeing in the mid and the small cap segment. Going forward, if the earnings continue to deliver at the rate in which it is forecasted, we can perhaps expect the returns to follow as well, though the expansion of the PE would not take place at the same level.
Okay, I'm coming back to you for this next question because I'm curious what you think. Generally, you would see in the more diversified scheme categories that there is a rotation that takes place. Fund managers take cognizance of the kind of shift that you see in various market capitalizations, and they shift themselves, particularly in the flexi cap category and in the multi cap category as well, where if there is a feeling that there is a little bit of froth in the broader end of the spectrum, they would rotate to the large cap space. Is that something that you've been witnessing in the schemes that you're paying attention to?
Absolutely. Not just, I think we have schemes, especially let's say in the flexi cap and the multi cap space, where some of those schemes have not just only taken a very high cash call, right? Where they're not only, let's say, finding opportunities to deploy in the large cap space, and they have significantly also pruned down their exposure to the mid and the small cap segment. Multi cap, by definition, need to maintain at least 25% of the exposure to mid and small on a combined basis, 50%. So let's say investors wanting to have exposure to that kind of segment could perhaps look at multi-cap as a category as opposed to let's taking a pure vanilla exposure to a mid and a small cap segments where funds or fund houses typically like to stay true to label. But if you look at, let's say, the other end of the spectrum, flexi cap, which sort of is really a quasi large cap fund. In that segment, definitely, I think the fund manager has really increased their exposure to large cap and pruned down the exposure to mid and the small cap segment. Yeah. So that's been the case for the last 3 to 6 months. I think ultimately it is for the investors to decide whether they want to continue staying invested with them.
Yeah, that's a fair point. In fact, we will talk about what investors should do in just a bit. But Pratima, I'm curious, in cycles that have taken place in the past, and you've pointed out that we've not really seen deep drops, and every dip has been bought into. You've seen some amount of time-wise correction, but it's been broadly a rally upwards. So from that perspective, in past cycles, is it true that large caps help you alleviate the pain of a large drawdown? And from that perspective, is it good to rotate out of the broader markets, especially if you've seen that in your portfolio, the rise in the broader markets has caused that skew to take place in your portfolio as well?
Absolutely. If you're looking at a tactical move, I think this makes a lot of sense. As we know, the markets tend to mean revert. If there is any market cap or any sector which has done very, very well in a sustained manner and grown very well over the last few years, couple of years, then it's likely that the one which is underperformed is going to, take over at some point of time and it'll mean revert. Now, it's all very easy to say it'll mean revert and therefore you should move into underperforming sector. How do you know we've reached the, absolute bottom? So it's not possible to know whether you've reached the absolute bottom. But if you look at the divergence between the returns of mid cap, small cap, and large cap is doing well, but relatively it's underperforming in a big way. So there was a graph which I was seeing, which is given by DS Pinetra, which shows the amount of deviation from the returns to small cap and mid cap is far, far higher than large cap. And in the past, whenever this has happened, it's completely the wrong time to be invested in mid and small cap. It would be better to invest in mid and small cap or increase your exposure to mid and small cap when it's bottoming out. So it's definitely not, it may or may not be at the highest, but it's very close to that. And therefore, it makes sense to rotate. But having said that, there is going to be exit clause, there's going to be taxation, there's a huge impact cost. So I think it's preferable to leave that choice to the fund manager, like Varun also just discussed. Flexi cap, though only flexi in name and largely has been large cap, may be a good idea to be in at this point of time. It will be nice to have a true to label flexi cap, which will move to mid and small cap at the correct opportunity, and it will minimize the cost of moving from one to the other in a very significant way.
That's a fair point. It's actually quite interesting that the multi-cap funds, and we've discussed this on this very program, that the multi-cap funds have done better in the recent past on account of their forced allocation towards mid and small cap small cap stocks. But another factor that we've been witnessing is that in the large cap space, the actively managed schemes have managed to beat the benchmark over the last 12 months, quite a few of them in fact. And this is not something that we've seen on a consistent basis for a long period of time. I would think that that's also because of the ability to deviate from the index, which some fund managers have managed to do. Varun, what is your reading, and why do you think that certain actively managed large cap funds, in fact, quite a few of them, have managed to beat the benchmark?
So Alex, as you correctly pointed out, obviously, if you just look at the last 1 year data, close to about 60 to 70% of the actively managed funds have actually been able to outperform the benchmark. But if we try and just extrapolate that to the next 3 to 5 years, right, over the past 3 to 5 years, on a 3 year basis, I think not more than 25% of the funds have been able to beat the benchmark. And on a 5 year basis, in fact, about 70% of the funds have underperformed, right? So definitely, I think in a more polarized market that we have seen over the last year, the fund managers were able to find bottom-up stock picking opportunities and deviated significantly from what we call as an active share, where they have a higher proportionate of the index of their portfolio, which is different from the benchmark itself. And that could work both ways. That could obviously provide you with that key to outperformance, but there could be periods where the portfolio is underperforming the benchmark itself due to the high active share, and which is required to deliver that alpha, especially since 2018 when SEBI came in and reclassified large cap funds, where the fund manager has mandated to take 80% exposure to large cap stocks, right? So the only sort of source of alpha for large cap fund managers is to be able to deviate from the benchmark in the large cap category and not so much from the mid and the small cap space.
Okay, that's a fair point. You want to add to that, Pratibha? Have you noticed something specific with regard to the ones that have outperformed? And we've been playing that list on the screen. Of course, Varun spoke about longer time frames where the outperformance kind of falls off. But particularly over the last 3 years, you've had schemes like Nippon India that have outperformed HDFC Top 100, ICICI Prudential Blue Chip. And the degree of outperformance is not small, 4.5 or thereabouts percentage points over the benchmark.
Absolutely. Varun spoke about long term. If you look at the very, very short term, 1 month, 3 months, 6 months, out of the 32 large cap funds, you see in 1 month, 20 of them have outperformed. In 3 months, 19 have outperformed. And in 6 months, 16 have outperformed. And, not only outperformed is one thing. Second, the quantum of outperformance, the alpha has been quite large. The top 3-4 funds have given a very large alpha over the index. But I don't think it's so much a question of, active or passive. At all points of time, it has to be active and passive, no or in between, because we are only comparing with index. But we have very smart funds now, factor funds, different factors performing very well. So I think you need to have a combination of both to do well.
Yeah, that's an interesting perspective. I have a combination of both active and passive. But to that end, I'd like to talk to you both about what you think are the foremost strategies and schemes that you've been looking at in the active space. We have played a few of the names of the schemes that have outperformed. But Varun, what stood out to you in the large cap actively managed space?
So a couple of schemes that we have been recommending us, or at least has been in the radar, are ones from ICICI Pru, HDFC Top 100, and the Nippon India Blue Chip Fund, right? I think these are the 3 funds that we have been recommending clients who want an active exposure to large cap space, even though we sort of continue to caution them from a longer term perspective. But let's say seeing the consistency of the performance, the kind of fund manager views that they have, where they are seeing opportunities today in the current market. So it's not so much of just, let's say, sectoral calls, but also very specific stock calls as well that has led to this kind of outperformance that we are seeing. So anyone looking at, let's say, specific names on a large cap actively managed fund could look at these 3 funds that we have been recommending.
Okay. Okay, so you spoke a little bit about the schemes, but I'm curious about what you have to say about the strategies that they employ and how they differentiate themselves from each other. You've spoke about specifically the Nippon, the HDFC and ICICI, if I remember correctly. What stands out about the strategies that they employ?
So I think, Alex, one of the things which have been common with all of these funds is the deviation in the portfolio holdings compared to the benchmark itself. And what I was talking about as having a high percentage of active share in their portfolio vis-a-vis the benchmark. So the higher the active share that you have, I think it is the lower the alpha that you need to generate to actually outperform the benchmark, right? So just to give you an example, let's say today, on an average, close to 40% of the large cap space has an active share. And in that case, we see that they need to deliver close to, I would say, about 5% alpha just to break even, and a 10% alpha to outperform the benchmark by 2%, right? So that is how important active share actually tends to be. And these, all the three funds that we have talked about, obviously definitely tended to have a higher percentage of active share, where the portfolio was different from, let's say, the composition point of view, but also the weightage point of view, which has led to that sort of an outperformance in these three specific funds.
Pratibha, the point is well taken about a combination between active and passive, but from my perspective, it's always been that the returns over the long term are comparable, at the very least comparable, with passive quite often beating active. And then you have to have active beat passive by at least a percentage point for it to make sense post cost, right? So how do you reckon that fits into the decision making?
Yeah, as long as the time horizon is long, you're not looking at, which I just spoke about 3 months and 6 months, and now I'm saying long term. But if you're looking at a time horizon which is long, I think there's plenty of space, especially in our country, where, active management can beat. For example, if somebody's got really punished, a Mire or a Canara Robeco funds, I think the time will come back if you are consistent in wanting to stay with them, irrespective of short-term underperformance. There is a lot of merit to what they're doing in terms of their philosophy, etc., which they are using, and they should be able to beat that, TER difference which they have of 1% should be done over a period of time, not necessarily in short periods of time.
Last question on this particular topic, and I'm curious what you think about this. Of course, there is no one-size-fit-all solution, but Varun and Pratibha, in your opinion, a moderately aggressive, a balanced portfolio that is based on your market capitalization, that you are doing it yourself, DIY, and you're not saying fund manager manage for me. What, according to you, is the ideal allocation to large cap, mid cap, and small cap? Varun, you first.
So, Alex, if you want to talk about today where we stand, definitely I think predominantly we would be constructing our portfolios with the large cap bias. So anywhere between 70 to 75% in today's market, right, is where we would be allocating our money across a combination of, let's say, large cap. That could be a index fund, that could be a factor-based fund, that could be a flexi cap fund with a large cap bias. So I would put my bets over there where having 70, 75% of my portfolio today to large cap. I think once the valuation starts to become attractive, once we see a certain amount of correction in the mid and the small cap segment, and what Pratibha alluded to earlier as well, I think it is when at that point in time you need to double down on your mid and small cap allocation to really generate alpha over a longer period of time. So 70, 75% to large cap, about 50 odd percent to 20% to mid cap, and about close to 5% to small cap. Now, small cap exposure could either be taken to through a dedicated small cap fund, or if you are taking an exposure to the multi cap fund, then that should also suffice. Though we today prefer the former compared to the latter.
Okay, and remember, this is a moderately aggressive portfolio that I've asked about. I'm not even talking about a conservative portfolio. Pratibha, do you have a similar opinion?
Absolutely. 65 to 70% large cap, largely taken through large and flexi cap. The idea being not to do too much of churning, if it's going to be a long-term portfolio, the rest can be mid cap and small cap, very with clear expectations that the same performance will not continue. It will probably, there will be a correction. But if you're there for the long haul, 7 years and 10 years, then it shouldn't matter.
Yeah, it's a fair point. Protect your downside is a very important rule when you're investing in the long term, because when you protect your downside, you're ensuring outperformance over the long term. There are several questions that have come through, queries that have come through. A lot of you have tuned in and asked. By the way, if you're writing in on that number that you see on your screen, make sure you tell us about the goal that you have. Why are you investing this money? What do you need the money for? Because that will help us ask your question in a better way. And how much do you think that you need to achieve that goal? Now, the first question is coming from Suresh Kumar. He's 50 years old and he has accumulated 20 lakhs by investing in an SIP form into the Franklin India Flexi Cap and the HDFC Top 100 funds. Should he continue investing into these funds is the question. Varun, at least one of them is something that you named in your favorite large cap fund. So he seems to be doing a good job there. But do you think he should diversify more?
So if we look at it just from a large cap exposure point of view, definitely both of the funds that we have selected, HDFC Top 100, Franklin India Flexi Cap Fund, definitely both of them quartile one funds would recommend to continue investing through them through an SIP. I think it is just that maybe we need to understand what your longer term goals are and for what you are accumulating this kind of corpus. If it is a longer term goal, then definitely I think you need to diversify a bit, add in probably a mid and a small cap exposure, and also take some allocation to international funds as well.
Okay, and you would suggest international funds through a passive approach, or is there anything else that you should look at?
So I would say a passive approach, a fund-of-fund approach is an easier way to get exposure rather than stock picking individual stocks, given the transaction cost and the taxation which is involved in that. So I think it's important to keep your portfolio simple, invest through a simple fund-of-fund that invests in the US markets, and I think that should suffice from providing a diversification point of view.
All right. The next question is coming from Suresh Babu. He is 52 years old and he's asking, can a PSB, a public sector bank sectoral mutual fund, be a good idea for a seasoned investor who does not mind high risk in investing? And this is, I think, you know, it's a sign of the kind of trends that we're seeing in the industry as well. A lot of people gravitating towards your sectoral and thematic funds. But the question is for you, Pratibha, would you suggest that this is a good idea?
It depends on what percentage of your portfolio is going to be in this PSB fund. As you can see, sectorial funds have a time frame within which you need to get in at the right time and get out at the right time. I would think it would be easier for us to outsource this job of getting in at the right time and getting out at the right time to the fund manager by going through a business cycle fund where they invest in the right sectors at the right time. However aggressive you are, this can be a small part of your overall percentage, not a very large part, because you want the journey to be smooth so that you can stay put investing. So I would think, yes, if it's a small part, yes, but otherwise, better to avoid.
Got it. All right. The next question is from Jashu Patel, who says they are 40 years old. They're investing into the markets through a 5,000 rupee SIP for the last 2 years. Is this the right approach to have from the perspective of the next 15 years? And we don't have real details about where Jashu is investing, but it's a solid start. Jashu is 40 years old though, and 5,000 rupees, I'm not sure what the goal is. Should they be incrementing their investment? What could you say about having having a step-up approach to investing in the mutual fund space? Varun, this one's for you.
So Alex, yes, I mean, obviously, I think if you're looking at smaller sums of money, but you have a really long runway ahead of you, I think you should always look at stepping up your SIP amount every year, which is in line with what your income or your business growth is, right? I think most of the people actually tend to fall off and keep their SIP amount consistent, right? So I think that top up that you're able to do actually helps you in definitely generating a significantly higher amount of wealth, right? And as I could see, I think obviously the portfolio is very small cap and mid cap heavy. So I definitely not recommend it. I think you need to add some large cap exposure, as we just talked about in the show. Small cap, mid cap space also have their period of outperformance and underperformance relative to the large cap space, right? So just to give you an example, let's say most of the people think that a small cap would definitely outperform large cap on a longer term basis. But just to throw you some interesting numbers, Nifty 50 TRI on a 5-year average basis has delivered close to 12% returns. Nifty small cap 250 TRI on a 5-year average basis has delivered close to 12.9% returns, right? So you could see the delta is not so much, where people definitely tend to over-index on small cap. You need to definitely have a balanced exposure across all the market caps.
Yeah, that's a very important point that you've raised. Of course, the timeframes are a little different, and let's see how that pans out. Sumi has got this question. She's 44 years old, and she's asking, she's started a 20,000 rupee per month SIP and will additionally invest 3 lakh rupees per year on her portfolio, and she's asking for suggestions on funds that she can invest in. So Pratibha, based on what we spoke about, 60 to 70% is what you're looking at in terms of large cap allocation. And just a caveat here, and none of the funds that we're speaking about, Pratibha or Varun, are recommendations. Please do your own research. Pratibha, from that perspective, which schemes would you suggest she can look at?
if she's looking at a balanced portfolio, she can look at as SIP of 5,000 each in Canada Robeco Blue Chip Fund, which is a totally large cap fund, Invesco Contra Fund, 5,000, Access Growth Opportunities, 5,000, and Mirae Asset Multicap, 5,000. So this multi-cap will also give the small and mid-cap exposure. However, when you're doing lump sum, if you're going to be doing it at this point of time, I would strongly suggest you do it as an STP over 15 weeks. But there's no guarantee that, the markets will correct in that 15 weeks. It may just happen to correct right after you're done with your STP, but still it makes for a good sleep in the night if you do it through STP. In the same funds, in the same proportion, 75,000 per fund for, to be allocated over 15 weeks.
Yeah, that's an interesting point that you've raised. STP gives you sound sleep at night. And, I must say that my own experience has been that I had to deploy a significant sum of money in 2020. And I did it by January or February of 2020. And it just so happened that I had deployed everything that I had to deploy in equity. I had, 15 to 20% in fixed income. And then the COVID-19 pandemic struck, markets crashed, and I was down 30+%. So, I mean, you can't really guarantee anything. I've seen this myself. Rahul has his next question, 37 years old. He says that he wants to deploy 20 lakh rupees into mutual funds. He's got a time horizon of 7 years, which is enough for equity. Would you suggest a similar approach, Varun, STP over 15 weeks?
Yes, I would probably increase that time frame to about 6 odd months. Right, compared to 15 weeks, again, you're probably just giving yourself a sufficient amount of runway so that if the correction does arise in the near future, you're ready to take advantage of that. And also one piece of advice is obviously we've been talking about markets remaining overheated for the last 12 to 15 months. So in that 20 lakhs, if you can sort of create some sort of a buffer in a liquid fund or an arbitrage fund, so you're much better prepared when the crash comes. Right, or a correction so occurs in the future, you are ready to take advantage of that opportunity. So definitely look at staggering your investments over a 6 to 9 month period. Create a portfolio. You have a sufficiently long time horizon in front of you. So obviously an aggressive portfolio is recommended for you, but do try to keep some sort of a cash buffer, not so much, maybe about 10-15% of your portfolio, so that you can deploy that when the market does correct.
Yeah, fair point. Varun, Pratibha, thanks so much for taking the time. This was a pleasure having you on the program. And viewers, that brings us to the end of this particular edition of the Mutual Fund Show. Hopefully it's been useful to you. And don't forget to send us your messages on that number that you see on your screen. Lots more coming up over the course of the day. And this is NDTV Profit.